sec.
And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
Hey, and good morning and welcome to the second best day of the week. It is, of course, Thursday. Got hiccups this morning all of a sudden. Michael Lebowitz joining me this morning. We're going to talk a little bit about, the dollar and what's going on with it and what it means and what's happening with a lot of different areas of the market due to the dollar. So we'll get into that this morning. Also talk about bonds, interest rates, the usual stuff. Fed meeting coming up here very shortly. We'll get into that as well, kind of what to expect, outlook for that. So all that's coming up this morning here on the show. So hang around to talk with Michael Lebowitz about that. Yesterday, of course, kind of the big announcement, got everybody all excited, was Stargate. I like these names they come up with, right? Stargate. Those of you back to James Spader and Kurt Russell, right? So, so Stargate, the big announcement yesterday, $500 billion of investment. Now, everybody got all excited yesterday, but, this is where you got to slow your roll just a little bit and kind of look into this. So first of all, this is just an announcement. It's like we saw the very same thing when Trump took office back in 2016. Immediately, carrier industry said, hey, we're moving a plant from Mexico to Indiana, right? That was the headline, got media attention everywhere because this is all about onshoring jobs. They interviewed Greg Hayes, the CEO of Carrier Industries, shortly after that on CNBC. And he's like, yeah, well, we're moving the plant because our parent company, UTX, United Technologies at the time, now Raytheon Technologies, has a lot of contracts with the government. So we want to make sure the government's happy. And most of these jobs are going to get automated away. We got a big tax credit in Indiana, and it's kind of a no big deal, right? Same thing here. This is just an announcement. First of all, SoftBank doesn't have the money for a $500 billion investment. They'd have to sell holdings in Alibaba and also potentially in ARM, which I doubt they're going to do. But they don't have the cash for that, and they've got a lot of debt. OpenAI doesn't have the cash for a $500 billion investment. So again, now it doesn't mean they can't get it. Doesn't mean they can't raise it over time. But see, that's the key issue. We talked about infrastructure spending and how that could impact the economy, create economic growth, et cetera. Very important point, right? But as we talked about yesterday a little bit, it's all about when this stuff happens. Well, this is $100 billion over this year, $100 billion next year, $100 billion the year after that. It's a 5-year program. $100 billion investment over 5 years is a drop in the bucket relative to what happens and really just the size of the overall economy. Now, is it not important that we're doing this? Absolutely, it's important, right? This is an investment into building out AI, keep us in the lead of artificial intelligence, just like the idea of putting a man on the moon, right? So that was another one of Trump's kind of discussion points yesterday I said moon, sorry, Mars. He wants to put a man on Mars in the next couple of years. And 2 years from now, right now we're going through a planetary alignment. It takes 2 years before we get that same planetary alignment again to put somebody on Mars. So again, within the next 2 years, they want to try to get somebody launched out towards Mars. That's a great investment. This is kind of the space race back in the 50s and 60s. Great for the economy, great for technology, great for innovation. So don't dismiss any of the good aspects of this. But yesterday, a lot of stocks were rallying very sharply around these themes, right? People piling into these stocks. Companies like Lunar and others, they have no revenue at all right now. And so there's a big risk that you're taking by piling into these companies now. They're going to take a long time for these themes to play out. It's going to take a long time for these investments in artificial intelligence to really start to show promise and start to show revenues, which we haven't had yet. Now, but again, this is just take this in stride. This isn't, something that's going to happen tomorrow. Markets acted like it yesterday. This is all going to happen tomorrow. We're going to have 500 billion in the economy. Read behind the headlines, right? This is going to take, 5 years. That's just what they announced, right? That's just the announcement. Whether or not that actually comes to fruition can be an entirely different matter at all. We've seen this a lot before. We've seen lots of announcements before that never actually come to fruition. So again, just be careful. The point is that these are all very, very good things. Don't dismiss the fact these are all very good for the economy. They're very good for innovation. They're very good for society in general, these type of things. Again, some of the greatest inventions that you enjoy today came from the space race back in the 50s and 60s. Your microwave oven, your cell phone, all those things that you have today all came from the innovation derived from that space race in the 50s and 60s. That could be the next leg of innovation for us as we do that as well. So again, don't dismiss the importance of this, but on your investing side, just, be a little careful chasing stocks on news, particularly when they're already extremely overbought and extended. So just be careful there. Okay, so having said all that, here's what you need to know before the bell this morning. Markets over the between December and the beginning of January, the stocks were kind of selling off. Lots of bearish headlines, right? Market's over, AI's dead, nobody wants to own technology, the Mag 7's underperforming. How things changed very quickly. We are now back at all-time highs as of yesterday. So just in the span of just a week and a half here, and a lot of this holiday driven as well, we have not only rallied back above moving averages and have turned moving averages back up higher. We are now challenging all-time highs. Now, don't be surprised this morning we have a little bit weak futures opening. I wouldn't be surprised to see the markets kind of stall here a little bit, digest some of this recent run. We are overbought on a short-term basis. So, again, just be careful chasing stocks here. I do think we're ultimately going to break out here and probably try to move a little bit higher here in the next week or so. We'll see what happens. There's a lot of positive momentum behind the markets right now. Sentiment is turning up. We have seen a lot of that kind of negative sentiment that we saw building with investors over the last really few weeks starting to turn around here. I'm sure that and again, this is part in our daily market commentary that went out this morning. We've got a couple of our gauges that are on SimpleVisor showing both fear and greed in terms of allocation, and technical overbought, oversold levels are at levels that historically have supported these types of rallies. And there's more to go for that. So, but again, just as we were just saying a second ago, just be careful chasing things here. This is where people start to kind of, oh my gosh, I'm missing it. I've got to get into that fear of missing out. That's where this starts to really kind of come into place. We've had a nice correction here. We'll eventually break out, probably try to move a bit higher from here, but just be careful chasing right here. Pick your entry points as always. Look for opportunities. Recently we talked about buying Palantir in our portfolio after it had a 20% correction. Look for those entry points, and that's what happens during these consolidations and corrections. That's where you get your entry points. And what happens with most people is they don't buy here. They want to buy after things start to break out and have big moves. And this is kind of typical of overall investor behavior. So, use weakness in markets as opportunities to pick up positions. Use rallies, as we've talked about over the last few days, to analyze your portfolio. And again, as we said yesterday, this is a great time right here. Nice big rally here. A lot of stocks have recovered. Go look at your portfolio today. What didn't recover with this rally? That's probably something you need to think about, maybe reducing in your portfolio, trimming out entirely, unless it's there for a reason. Again, some positions are okay to have if they're a hedge against risk. That's completely fine. But just make sure that you're not calling a bad position a hedge just because it's not working. Right? It has to have a reason that it's a hedge. What's it hedging against, right? Volatility risk, interest rate risk, whatever it is. But just because a position is underperforming doesn't mean it's a hedge. So, there's a difference between a good hedge and a bad investment, and just make sure you understand the actual difference of that. Just very quickly as we wrap up, one thing here is that also volatility is continuing to decline. Again, that's a bullish sign. Volatility tends to, track kind of where markets are. And again, as markets continue to rally, volatility, that fear gauge continues to decline. So again, there is support here for a further rally. So expect that to happen. But again, just kind of pick your entry points and rebalance risk as you need to go along. All right, that wraps up what you need to know before the bell this morning. When we come back, we'll get in with Michael Lebowitz by what you need to know about the dollar. Don't go away.
Now for something.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Will you be turning 65 in 2025? Happy birthday! But there's a Medicare special enrollment period in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid those gaps in coverage. Click on the Insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Lebowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Lebowitz.
Welcome back to the show this morning. Of course, as always, Michael Lebowitz joining me on Thursdays. We've got a lot of stuff to get into this morning. Mike, good morning. How are you? He's great. He's telling you right now he's great. So he's there. There he is.
I couldn't hear anything you were saying in the first segment, but it's loud and clear now, so we're ready to go.
Well, that's great you can hear, because all I did was just talk badly about you for the first segment. So just nod and agree that everything I said was correct, and we're awesome. Real quick before we get into kind of talking about your article and stuff that's going on. I got a good question in our chat this morning, asking just about, because we talk about this a lot. We talk about in our portfolio management, we talk about how to take, we talk about taking profits, rebalancing risks, those type of things. And the question in our chat was, please explain how to trim and take a profit on a stock you already own. And I think this is a really good kind of discussion topic here for you and I, because this is what we do, pretty much every day. And, the first part of the question, which is, owning a stock, the one mistake that investors make is they don't weight the position in their portfolio, right? They buy a stock and it goes up and they're making money in it and becomes a larger and larger position in the portfolio over time. And as it increases in what we call concentration, and it's interesting because investors right now they're so concerned about the concentration risk in the markets, right? Apple, Nvidia, the top 7, the Mag 7, it's all over the news. It's like, oh my gosh, this concentration risk in the markets that's just gonna crash things eventually. Yet I can't tell you how many portfolios that I look at from individuals that have concentration risk in them. So you're worried about concentration risk in the overall markets, but you're not worried about it in your portfolio because you're making money, right? And this is one of the very basic rules of managing and investing capital over time is that you weight your positions in your portfolio. So before you ever buy a position, you go, okay, my maximum position size in my portfolio is 5%, right? And there's a reason for that, because if you buy a stock and it's 5% of your portfolio as an example, and let's just keep things really simple for Mike and I to have this discussion. If my portfolio, if that position goes to 0, which can happen, right? Enron, WorldCom, the list of companies that have gone bankrupt literally overnight or long. So if you lose 5% of your portfolio overnight, yeah, you're down 5%. That's survivable, right, for individuals, right? So now you can, okay, that didn't work out well. Company went bankrupt, whatever happened. So now I just got to rebalance the other 95% of my portfolio, and I've got to grow that 5% back. That's achievable. But when you have a position in your portfolio that starts to make up 10, 12, 15, 20% of your portfolio, which I've seen a lot, particularly with people that have corporate investments or invested in company stock, in particular, they'll have a very large position in their portfolio. Well, we don't think about the risk of that, but if tomorrow morning you wake up and you own GM and GM goes bankrupt, which they did, you lose 20% of your portfolio or 30 or more, whatever, however big that concentration is. So one of the very basic rules is to manage your position size so that you can weather a very sharp problem that can and often will occur within a position over time. So Mike, before we get into just kind of the taking profits and rebalancing, just any thoughts on that?
Yeah, it's everything is relative to each other. So whether you decide 5% is great, 2%, or you have some stocks that are 2%, some are 5%, some are 3%, it's all, you have to think about each stock individually, which we all do, but then think about them in relation to each other. And does one go up? Does one go down? Do they diversify, or are they all very similar? So, like you said, Lance, you don't want to own a 20% position in NVIDIA, or maybe you do, but if you have a 20% position in NVIDIA and Broadcom and AMD, you also have some similar risks. That not that one of the companies could have a problem, certainly, but something happens with the industry. There's a new regulation, a new tax, a new competitor that we hadn't thought about. So, it's also just sizing according to the whole portfolio, to the market, to other holdings.
Right, and what Mike's talking about is correlation risk. In other words, you own AMD, Broadcom, and NVIDIA. They all have basically the very same beta. They will go up and down together because they're all in the same sector. They have a very high correlation risk with each other, which is a key point to be looking at. And this is why, if you look at our portfolios, we publish our portfolios on SimpleVisor, as we were talking a little bit about yesterday. And if you take a look at that portfolio, you'll see all different weightings in the portfolio. You'll see some stocks at 5%. You'll see some stocks at 2%. And the reason is because we're weighting that risk of each position relative to the whole portfolio. How much risk are we willing to take? And then also there's one other step from this that Mike was just addressing, which is also what is your objective, right? So let's just assume that our objective is to beat to at least match the benchmark index. So we're running 100% equity portfolio. We want to match the S&P 500, right? So my goal would be, to match or beat the S&P 500. Well, I can do that simply by just matching weightings within the index. So if my technology sector of my portfolio, the amount of money I've invested in technology stocks in my portfolio is relatively weighted to the S&P 500, I'm going to have relative performance to the S&P 500, assuming I have, similar stocks. If I overweight that a little bit because I really think technology is going to do well this year, then I can outperform the index by having a slightly overweight position in those same stocks. So understanding what your benchmark is or what your goal is. My goal is to generate 3% a year or 5% a year, whatever the number is. Weight those positions accordingly so that you can manage your risk and your returns as a function of that weighting. Now, this
Lance,
go ahead.
If I can add, this is important.
Yep.
Like we spend a lot of time thinking about sectors, not necessarily. We talk about stocks as well, but we talk about sectors, and sectors become over and undervalued versus the market and versus each other. And we look at SimpleVisor 2-3 times. I look at it all the time, but I'm looking at our sector analysis few times a week, because that's telling us, like right now, staples are very cheap compared to just about everything else compared to the market. So over time, we should expect staples to outperform, something else to underperform. So it's kind of having that broad macro view of the market and then diving into some of the stocks that make up those sectors.
Right. Now, let's get to the actual question. So now we understand weighting, right, to some degree, right? How do I weight my portfolio? And that's relative to kind of what your objectives are and how everybody weights their portfolio differently, but it's about risk management. So a great way to go about trimming and taking profits, et cetera, is, and this is the way Mike and I do it, and again, this is just the way Mike and I do it in our portfolios. You may do it differently. A lot of people just kind of arbitrarily just pick a percentage, right? I'm going to sell 15% of this, or I'm going to sell 20% of that, whatever it is. And it's kind of just arbitrary. But if you have a weighting, if you've weighted your portfolio and you have a model, again, you have your portfolio and you have your model. So I've sat down I've written down on a piece of paper. This goes back to our conversation the other day. We've still got that whole conversation pinned on our YouTube channel about having an investment policy statement. But you have a model portfolio. So these are my 20 positions, 40 positions, however many I own. This is how they're weighted. So my target weights are, 5% for these 20 stocks. That makes up 100% of my portfolio. Well, if the stock grows to be 7% of the portfolio because it's been doing very well, but markets are very overbought now, we're talking about taking risk, rebalancing profits, you simply just reduce it from 7% back to 5%. Or if it's been under a lot of pressure recently because it's gone through a down cycle, which happens, and now it's 4% of your portfolio and it's really oversold, this is when you bring it back up to weight. So having this model gives you the guidelines for taking profits and for when to add to the position. But see, if you don't have that model to work from, you're just kind of throwing darts at a dartboard. You really don't have any type of structure to work around on your portfolio. So build a model and then work your portfolio relative to the model. Most people that I see, when they're investing in the markets, they're just kind of buying a little bit of this and a little bit of that, and they hear some guy on television that talks about this, so they'll throw that in the portfolio. They really have no idea how any of the positions work within respect to how they perform relative to each other, and they really have no guideline with how much to buy or how much to reduce or anything else because they don't have a basic model. So if you build your basic model first, then when you want to buy a new position, you say, okay, great, I want to add this new position to my portfolio, but my portfolio is full. Well, I've got to sell this underperforming position to make room for this new position. So that also helps you, having that model also helps you trim losers add your winners, those type of things, so that you can build better performance over time. Mike, any last comments before we end this segment?
Yeah, I think NVIDIA is a great example. That's a stock we started buying, 2 years ago, maybe even more than that. And we have trimmed it multiple times. And back from the original investment, we're now playing with the house's money because we've pulled more money out of NVIDIA than we originally invested. So we still have a position, but we've taken those profits and put them to use in other things. We have the money. So that's just one example.
Yeah, it's a good point. All right, we'll come back. Let's talk about Mike's latest article talking about it's the dollar, stupid. I can't believe he called Brent stupid, but, that was the name of his article. We'll come back and give that with Michael Lebowitz right after the break.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
So how many Gen Zers to take change the light bulb? 5. According to a new study conducted by the motoring and cycling retailer Halfords, 1 out of 5 could not change a light bulb.
The Real Investment Show podcast.
1 in 5 feared that the light bulb was too hot to touch.
Same show, your schedule.
And just when you thought it couldn't get worse, 20% said that going up a 5-step ladder was simply too dangerous.
At realinvestmentadvice.com.
We have failed as parents.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell reports, Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows, and the latest analysis from Lance Roberts and Michael Lebowitz. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. Just a couple of housekeeping notes, as always, as we do the show. Please like the channel. We've got about 600 of you hanging out this morning watching the show. We appreciate that very much on YouTube. Just give us the, smash that like button for us. That certainly helps us, as we said before. Also, if you haven't subscribed to the channel, make sure you subscribe. That also helps us, as well as also alerts you whenever we post a new video. So as we have new things, we have a lot of plans for this year to do some new stuff as well. So just make sure that you're part of the YouTube community as well. Keep you up to date and informed about all the things that we're doing. So we do appreciate it very much. It helps us a lot more than you realize, and it doesn't cost you anything. So, by the way, there was quite a few of you in our chat were at our economic summit on this past Saturday. It was nice. It was great to meet you. Mike was there. Obviously, we had a good time. And so, like I said, certainly want to see y'all here next year. We just had a big kind of post-mortem yesterday on the conference. We have some really good ideas for next year. So put that on your calendar for January of next year. We will certainly do that. And we're probably going to do a virtual event, kind of a virtual summit sometime later this year. We're starting to talk about maybe doing one of those for and people that live all around the country. And you're watching on YouTube, you don't live in Houston. We're going to do something virtually for you as well. So anyway, a lot of things coming up here. So just stay tuned. Again, you're going to find out about that if you're subscribed to the YouTube channel. So, Mike, let's talk a little bit about the dollar, stupid. I'll just let you just kind of start with the premise.
So I posted last week. We talked about my article, the bond yield term premium, and the basic but the basic thought within the article is that inflation and economic activity are what really drive yields, and then you have this sentiment. And I posted the article on Twitter, and someone wrote back, "It's the dollar, stupid." And I was like, you're right. I didn't talk about the dollar. The dollar is vital, right? We talk about what are yields? Yields are just the cost of money. Money is the dollar. It's not just our dollar. It's the world's dollar. It's the reserves currency. So I thought it was worth writing another article on the dollar and yields and their correlation. So, accompanying it's the dollar, stupid, is a graph, and it shows the dollar and bond yields are traveling neck and neck for the last 2 years. They go up, they go down together. So clearly, obviously, right, the dollar is what's driving yields, or yields are what's driving the dollar. But when you go back in history and look, there are periods of strong correlation, periods of negative correlation. The correlation just goes up and down. And the longer you go back in history, the more you prove there really is no sustainable correlation. Again, it doesn't mean there aren't periods where there's very strong correlation, and there are other periods where there's a very negative inverse correlation. But it's important to understand the dollar and what it is. The dollar is used, again, not by us, it's used by the world. When Thailand wants to buy something from Peru, they're using dollars, right? Everyone's using dollars. So the value of the dollar has a big effect on their economy. So, for instance, if you're in Europe and you're making widgets and you're selling them to America, and the euro goes from 110 to 1, you're now making 10% less on the widget you sell in dollars. That's a big deal. That hurts profits. That causes economic weakness. So when the dollar's strong, it's harder for foreign companies to make money. It's also more expensive for them to borrow money. Remember, they have to pay back in dollars. So if they borrow $1 today and the value of the dollar versus their currency goes up, they have to pay that higher value. It's not like us where if we borrow $1, we pay back $1 plus interest. So there's a lot of complicating factors that when the dollar rises, the U.S. economy can be okay, but it's really dragging on the global economy. And there's a huge correlation between the U.S. economy and global economies. So the U.S. really can't escape the grasp of those economies, but it can take a little while. So, it's kind of, the article is a long way of saying that, yes, there is a correlation, and there is some fundamental merit to it. But at the end of the day, that same relationship is probably what's going to force yields lower because you're sucking liquidity out of the rest of the world. You're hurting the economy of large part of the rest of the world. You're also hurting our exporters because our goods are now more expensive. And by the way, our imports are cheaper. Cheaper imports are deflationary. So why are yields rising if imports are cheaper, if we have this deflationary influence? So the point is there's a ton of influences. Some are inflationary, some are deflationary, some are good for yields, some are bad for yields. But, and we have this very high correlation. And my guess is a lot of traders are trading off that correlation. If they see the dollar go up, they sell bonds, so yields go up and vice versa. That will break. It always breaks. It always has broken. Mm-hmm. And it will break. And if it doesn't break, the world's central bankers will break it because none of them, including the U.S., want to see the dollar keep going up and up and up. And Trump is talking strong dollar. Every president and every Fed president has talked about a strong dollar. They don't necessarily, they want a stable dollar. They don't want a very strong dollar. They don't want a very weak dollar. They want stability. And that's what every other central banker wants as well.
Yeah, and two real kind of key points here, that 41% of the S&P 500 revenues come from export. So almost, approaching 50%. This is a much different economy today than it was back in the 50s, where, as an example, where we were pretty much the manufacturing production hub of the world. There's no longer that case anymore. We have a lot of revenues that come in from overseas, and so to your point, a strong dollar detracts from earnings growth. And in fact, there was a really good chart out this morning talking about earnings revisions. Earnings revisions for the fourth quarter are now estimated have fallen sharply, and now earnings are estimated to be less. The earnings growth, is estimated to be even less than it was in the third quarter. So we were at about 14% earnings growth expectations a year ago. That's now down to 8%. So, this strong dollar impact will impact earnings and impact revenues, which now with markets at all-time highs, you have this very sharp decline in earnings estimates. Kind of makes you ask the question, exactly what are you paying for and what are you getting? But, that's a real important point to remember, is that there's a big impact to corporate revenues that comes from our exportation base. And to your second point about, a stable dollar, again, it was always interesting to hear people talk about, China's manipulating their currency. Everybody manipulates their currency. We've been doing it since 1913 because, to your point, Mike, we want a dollar that allows for good, steady, stable trade. We don't want one that's too strong or too weak that impacts international trade. And particularly that is the case more today than it's ever been in history because of the globalization of the economy.
And we've talked about crypto. What's one of the biggest problems with using Bitcoin as money? It's the volatility. Mm-hmm. The thing is moving up and down 5 or 10% every day. If I go buy a house, all of a sudden that house could be 10% more than I thought it was, or 10% less, because the value of the crypto has moved. It's the same with dollars. They don't move 10%, or currencies. They don't move 10%. But when you're talking about these mega corporations and international trade, a 1 or 2% move is a really big move for the markets.
Right. Well, and think about it. So, think about your ExxonMobil, right? Just a good example. One thing that Trump talked about yesterday was removing LNG bans so we can export LNG to Europe. It takes about 2 weeks, a week and a half to 2 weeks to ship a tanker all the way across the sea, right? So if you have something super volatile, and I have my tanker leave the port of Houston on Monday, and they don't get to France or Germany until a week and a half later, if currencies have moved a tremendous amount between those 2 points, it becomes problematic for that kind of trade, right? So things that I can deliver immediately over the internet, maybe not so much, but things that I have to actually ship, volatility of the currency is very important. Stability is the most important thing that importers and exporters want to have.
And to add to that, the more volatile so these Exxon hedges the currency. They hedge oil, they hedge the currency.
Yep.
So they're not necessarily susceptible to big variations in the value of the dollar versus other currencies. But those hedging costs increase significantly the more volatility there is, which just weighs on their profitability again. So whether it's the actual dollar movement or the hedging costs, the more volatility, the more unstableness, the more of a weight it is on both the global economy, but also it has a big impact on our U.S. companies as well, like you said, Lance.
So when we come back from the break, Mike, let's pick up a little bit. We've got the Fed coming up here in the next week after.
Next week.
Yeah, next week. So let's talk a little bit about what expectations are and, kind of what to expect from the Fed, what that might mean for the markets at this point. It seems like markets are now starting to price in, an additional rate cut or so this year. And we've been playing this game now for the last really 3 years is, how many rate cuts this year? And the markets respond to that. So we'll talk about that when we come back from the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
You're listening to The Real Investment Show.
All right, welcome back to the show this morning. Just real quick, one thing that Mike was talking about in relevance to the dollar and some of the things that kind of the fundamental drivers of interest rates over time, deflate. We import disinflation, particularly from Europe, where they're on the verge of almost recession. We import that deflation. We export our inflation through our actions within the economy, manufacturing, offshoring, those type of things. But while the fundamentals suggest longer term that interest rates are going to be lower as the economy slows down, as we return to normality following the 2020 pandemic, in the short term, interest rates can do a whole lot of things that have nothing to do with the fundamentals, and that's all about sentiment. So again, you have a lot of hedge funds, pension funds, et cetera. There's a trade going on. Everybody's shorting bonds. As they short bonds, that drives yields up. That gets more people to short bonds. It's just the same way with the stock market. When the stock market goes up, it sucks more and more money into the long trade of the market, so everybody starts buying stocks. Same thing with yields. When yields are moving in one direction or the other, you get this kind of FOMO that pushes those yields further than they should be. The term premium is a measure, right? It's just the difference in the spread between where yields should be and where they are in actuality. That's just the measure of sentiment. There's no way to calculate term premium. It's just the spread. So, what goes on in the very short term, 1 month, 3 months, 6 months, whatever, that's all just sentiment. That's just sentiment being driven by the markets. It goes too far in one direction, then we get a reversal in rates, and then it goes the other direction. That term premium is just the measure of the sentiment. And right now you have this term premium going on. This is what everybody talks about. It's like, oh, it's the term premium driving yields. No, that's just sentiment. That's just the trade that's going on. Eventually fundamentals matter, pull yields back to where they're supposed to be. So as long as you understand the fundamentals, you're in good shape. Go ahead.
Let's also talk about Bond Vigilantes real quick.
Sure.
What are they? They're not good guys. I think the media, social media, kind of makes Bond Vigilantes out to be these guys that are shorting bonds and hope that the government wakes up and stops spending money and cleans up the deficit and the economy does everything the right way, the productive way. Bond Vigilantes are just large institutional hedge funds and others that are trying to make money when prices go down, yields go up. That's all they're doing. They will exit that trade in a heartbeat when they think it's going to go in the other direction, regardless of what happens with deficits or what happens with the government. So don't mistake the term bond vigilante as a good guy, a good person. They're just trying to make money in the markets just like every other investor does. So that's kind of one of those words that has been thrown around a lot that kind of bothers me because they're not vigilantes. They're just profit seekers like everyone else.
And by the way, they've been talking about bond vigilantes since 1980, right? So, it's just, again, these are just terms that are put out there. It's great bear porn, scares the bejeebers out of people. But let's just talk about the Fed here real quick. They're going to meet next week. Expectation right now is the Fed will not cut rates at the next meeting. I guess the real question is do you see a big change potentially in their tone or in their messaging that they may be more concerned about higher inflation or stickier inflation for longer versus their kind of previous messaging was that their long-term outlook is still, inflation returns back to 2% and they're going to navigate accordingly?
No, I think based on all their speeches over the last few weeks and kind of their change in tone at the last meeting a little bit, that they're going to stick to that last tone, that they're going to say we're basically on hold, where we certainly can lower rates, and if we need to, we'll raise rates, but they'll lean towards the lowering rates. But we want to see inflation come down, and it's kind of the sticky inflation that I think will be their what they base a lot of stuff on. That inflation is sticky for the time being. But one of the things we've heard basically all of them talk about, and we've talked about it way too much as well, is CPI Shelter. And there's a new piece of data that just came out. It'll be interesting to see if they talk about that. There's a thing called the new rent index. And basically the problem with CPI Shelter is it's measuring everyone's rents, whether you've been in your place for 3 years or you just moved in. The new tenant rent index is just for people that just moved in. So it's the going market prices. That thing plummeted 5% quarter over quarter, and it's now down about 2.5% year over year. It's really coming down quickly. But CPI Shelter, because it's only 5%, approximately 5% of rents are renewed every month, it can take 20 months before new rents fully, before the data finally catches up. So it'll be interesting to see if they bring that point up again, because if you take shelter out of CPI is below the Fed's target already. So I have the feeling that it's going to be a very boring meeting, that they're going to repeat a lot of what they said at the last meeting. Obviously, things change, and they may be trying to steer the market, but I think they're happy. The market right now is pricing in 1, maybe 2, and it's kind of fluctuating back and forth between 1 and 2. And that's more or less in line with what their expectations were at the end of December. So the Fed likes it when they've lassoed the market into their point of view. And I think they're just going to keep them there until we get more evidence, especially as we get into February, March, April data. You get the holiday season kind of out of it. And I think that'll be a little more telling on what's going on with inflation, with employment, with the general economy. So until then, they're just going to kind of bide time and kind of repeat the same stuff they keep repeating.
Well, again, this is, if you take a look at forecasts for interest rates, what's the market expecting? They're expecting kind of some stability here over maybe the next, 3-6 months, that the Fed may not cut rates. But then when you start looking out latter half of this year and into next year, they're expecting Fed funds rates to be back down towards 3% versus where they are now. So, fairly sharp set of rate cuts beginning kind of really later this year, next year. And of course, you have to ask the question, well, why is the market expecting that? Because there's no reason, if economic growth is strong and stable, and we're going to grow at, 2.9% or 3% growth over the next year, then there's really no reason to cut rates much, because that, if you're running at 3% economic growth, you're going to have inflation right around where it is now, 2.9%. That would make complete sense. So you have to almost ask yourself, why is the market expecting such a sharp decline in Fed funds rates next year if everything is fine economically? Earnings are going to be great. Take a look at earnings forecasts going out in 2025, 2026. They're expecting very strong earnings growth, but earnings come from economic activity. So you've got to, we've got to kind of look out there and say, okay, what's coming down the road that we need to be aware of, and what the markets are suggesting is that economic growth is going to weaken once we get past kind of this first half of the year. We'll see what happens. Again, these predictions are going to change all the time, but it's interesting to look at what they're forecasting.
And I've done a couple studies on this, Lance. The Fed funds futures market is always wrong. It always underestimates the Fed. So when the Fed's raising rates, it doesn't really factor in how much they're ultimately going to raise rates, and vice versa on the downside. They never really fully price in how much they're going to lower rates. So, right now it certainly does seem like the market's got it right that the Fed's on hold. But again, you have this faulty shelter number that if it just corrects a little bit more than expected, you could see a decent drop in CPI, and the Fed's tone could change pretty quickly, especially if there's any kind of slight uptick in the unemployment rate, or something in jobless claims that leads the Fed to believe that what's going on around the world, right? I mean, Germany is more or less in a recession. China is slowing drastically. This world is really globally borderline recession, and we're not immune from it. We can certainly buy some time. The Fed knows all this, and the Fed probably does want to cut rates, but they can't right now because the bond vigilantes are kind of holding them hostage.
Yep.
Right? If the Fed cuts, bond yields go higher. It creates more of a deficit. It just creates problems. So, I think that's what they're going to have to grapple with over that's kind of the next 3 to 6 months, is their tone versus the market,
right.
The bond market.
Well, again, this will be interesting to see, because they're still doing quantitative tightening, right? They're still reducing their balance sheet, which is also putting some pressure by removing a buyer from the bond markets as well. So again, they have some levers to pull if they need to bring the bond vigilantes back in line, so to speak. They can do that pretty quickly. But one thing,
and Lance,
go ahead.
I was going to say, this is important. We potentially have liquidity issues coming down the pike, right? The Fed's repo program, which is all the extra liquidity in the market, is almost down to zero at this point. So, you just mentioned QT. QT drains liquidity too. So it wouldn't be surprising if over the next few months, there's also signs that liquidity is becoming problematic, which is also something that would get the Fed to stop QT, to potentially lower rates, just like they did in 2019.
So thanks, Mike. Appreciate that very much. Be sure you're by the website, realinvestmentadvice.com. Mike's latest article is out on the website now. It's called "It's the Dollar Stupid." Also, we have a few other articles that are coming out on the website as well, covering financial planning, retirement planning, all those type of things. So we've got a lot of stuff on the website for you now that we've started out this year with, and that's going to continue. So not only if you go to our website, realinvestmentadvice.com, are you going to get articles from myself and Mike, but also from our entire team. So we've got all kinds of stuff being put on the new website, realinvestmentadvice.com. Certainly suggest you check it out. Make sure to like and subscribe to the channel. That certainly helps us out as well. And also, again, if you have any questions or comments, plenty of ways to reach us through the website, realinvestmentadvice.com. Just ask a question, answer every question every day. So if you've got a question, email me. Let me know what I can do for you. All right, y'all have a great day. Danny Ratliff, Richard Rosso in tomorrow, and I'll see you back here on Monday.